You're welcome again to another class. Today, we want to look at the concluding part of IAS 36, as well as IFRS 15 on revenue from contract with customers. Last week, we started IAS 36, but I can remember that we did not finish it. So I will finish it today. And I told you that when it comes to impairment of assets, which is IAS 36, the aim is to ensure that the carrying amount of an asset is not higher than its recoverable amount. That's one of the objectives. And it further stated that if it happens that the carrying amount is now higher than the recoverable amount of an asset, then that asset is said to be impaired, which is basically what IAS 36 wants to look at. Then we looked at some definitions of impairment loss, which is the amount by which the carrying amount exceeds its recoverable amount. We looked at what carrying amount is. We said the carrying amount is the amount at which you recognize your assets in your financial position. Of course, that amount you will need to deduct, you will have deducted the accumulated depreciation and accumulated impairment losses from either the cost or the fair value of that asset. But that is carrying amount. The amount an asset is recognized after deducting accumulated depreciation and accumulated impairment losses. Also, we say recoverable amount is the higher between the fair value minus cost to sell and the value in use of an asset. That's the recoverable amount. And when it comes to fair value, we say this is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. We did fair value last week, so you know this already. So recoverable amount is the higher between that fair value, but you need to deduct cost of selling from this fair value. So it becomes net realizable value. And the value in use is the present value of future cash flows from using an asset, including its eventual disposal. So this standard is relatively straightforward. What IAS 36 wants to achieve is that whatever amount at which you recognize your asset, it should never be higher than its realistic value. Don't overvalue your asset. Don't let it be higher than realistic value. And the realistic value, we see it as the recoverable amount. The recoverable amount. So if it happens that the carrying amount is higher than its recoverable amount, then impair the asset, impair it. And that impairment, meaning that you're going to write off that excess to P&L. So we looked at these three items last week. This is what we looked at: how you identify an impairment loss, how to determine recoverable amount, and how to account for impairment loss. So in identifying impairment of assets, we looked at these external indicators, which I explained to you last week, and also these internal indicators. However, I told you that after you have confirmed many of these indicators, then that means you will need to move to the next stage, which is to test the asset for impairment. So impairment review before impairment test. So when we say impairment test, basically what you're doing is determining the recoverable amount of an asset, of course, so that you can compare it with the carrying amount. However, there are certain type of assets that does not require indication. Even if there are no indication, you still test them for impairment. And these type of assets are an asset or an intangible asset with an indefinite useful life, They are tested for impairment annually. And second one is goodwill acquired in a business combination. It's also tested for impairment annually. Then we looked at how to measure recoverable amounts by looking at this question last week. And also we looked at how to account for impairment loss. I asked you the double entry. And I also told you if there was a previous surplus on the same asset that was impaired, how do you deal with that? And we explained that the first thing we need to do is to take that loss to OCI first, then any excess can then go to P&L. So we explained that. We explained that last week. Now, today, I'm going to be starting with cash generating unit today. So the entirety of what we talked about last week is just around comparing recoverable amount with the carrying amount of an individual asset so that we can determine an impairment loss. The problem is never the carrying amount because that will be in the books. So where effort is required is in determining recoverable amount. Effort is required there. So because you will need to get how much you can sell the asset immediately, which is the fair value. And if there's any cost to sell, you have to deduct that. And also, you also need to also get, okay, if I continue to use these assets throughout its useful life, how much will I make every year? You will need to discount that to present value. That's the value in use. So effort is required in getting recoverable amount. However, there are certain type of assets. In fact, a lot of assets might not have recoverable amounts readily available. You might not be able to get their recoverable amount, right? For example, your laptop that you use in an office, or the furniture and fittings in an office, or an air conditioner, or just think about any assets that on its own does not generate money. Any asset that does not generate money on its own, there is no way you can determine its recoverable amount because recoverable amount is the higher between how much you can sell an asset and how much the asset makes. That is, if you continue to use this asset, how much can it make on its own? Then you then discount all that to present value to get value in use. So if you cannot directly trace how much an individual asset make, that means it becomes impossible and impracticable to get recoverable amount. So does that mean you are not going to impair such assets? You still have to. So the solution we have in IAS 36 is what we call cash generating unit. That we understand that the reality of some assets is that they don't generate money on their own. But by the time you look at them together with other assets, then you would be able to trace how much they make together. So for like an office building, for example, now, an office building. So by the time you are picking the elevator, air condition, furniture and fittings, laptop, generator, individually, you might not be able to get how much they make individually. But by the time you are looking at everything together, like, okay, instead of taking them separately, why don't you take the entire building or even the entire business? That, okay, how much does this business generate? How much does it make? So by the time you do that, then we will be able to get our recoverable amount of that group of assets. So that is why IAS 36 defined cash generating units as the smallest identifiable group of assets that generate cash inflows, largely independent of cash inflows from other assets. So you have to have it in mind that the only essence of cash generating units is to help us get the recoverable amount of a group of assets. That is its purpose in life. As soon as you get the recoverable amount, then its purpose has ended. But what you need to understand as a reporting student is that a cash generating unit means a collective assets that you can say that, okay, this is how much this group of assets, this is how much they make. You can know how much they are making together, right? Then that's cash generating unit. It could be a business. It could be a branch of a business. It could be a group of assets, right? But what's important, the substance there is how much do they make? If you can know that, then that's a cash generating unit. Then with that, that has solved the problem of individual asset that you cannot get their recoverable amount. That has sorted that. And as soon as we have our recoverable amount, then it then becomes easy for us to then determine impairment loss. It becomes easy. So it's just for us to compare that recoverable amount with with the to compare that recoverable amount with the carrying amount, then we have an impairment loss. So that is it for cash generating unit. But I need to ask you a question right now. So let's assume that we have group of assets together and we're able to get the recoverable amount. Let's say the recoverable amount is let's say 50 million. And by the time you had their carrying amounts together, their carrying amount is let's say 60 million. So the carrying amount is higher than, the recoverable amount by 10 million. So that's an impairment loss. I need somebody in this class to tell me the double entry for that 10 million. Please be fast. We have a lot to cover today. What's the double entry for that 10 million? Anybody?
You write off the impairment loss. So you debit P&L and you credit the assets. So you write it
Okay.
down to the value of the recoverable amount. Are you referring to a particular asset or the group now?
Of course, it has to be the group now. I'm talking about cash generating unit. So you
Oh,
debit
okay,
P&L.
okay, okay. That becomes more complicated because you have different assets there. So
Good, fantastic. So that's what we want to solve now. So how do you think we can do it? What do you think we can do? Any suggestions? You guys are professional students, so you have ideas of these things before. What do you think? I need
I think it's done
professional.
if we recall what was done in
You
FR,
have to
it's done in phase.
debit the OCI, and
Okay.
you credit the assets, the fixed assets. So
No. OCI doesn't come in right now. Robert has already mentioned the major challenge we have. You are debiting P&L, fine. And of course, you credit assets. But now, we have group of assets. So,
you first obviously impaired assets.
okay, go ahead.
Then
You will do what again?
after
Repeat yourself, Ayodele, sorry.
uh, uh, I'm just trying to. So I said
Okay.
you obviously impaired assets. So the assets that
Okay.
are obviously impaired, maybe assets that were burnt, that were had fire incident, those kind of assets, you first impair them.
Okay.
Then I think you are going to your goodwill. You are going to impair your goodwill. That means you take goodwill, you want it to zero.
Okay.
Every other one, you are going to share it, the remaining amount.
How? How are you going to share it?
So since it's 10 million that is our impairment loss. So if we impair
Okay.
our obviously impaired asset, let's say our obviously impaired asset is 5 million, right?
Okay.
That means 5 million has gone. So obviously impaired asset.
Yes.
Then the goodwill, let's imagine our goodwill is now 2 million.
Okay.
That means you now, that's another 2 million. That makes 7 million. Then we have 3 million that remain.
Okay.
Let's now imagine we have um, three other assets that we have not
It's on pro rata.
allocated. Exactly. Thank you. Then we'll put it on
Thank you
pro.
very much. Thank you very much, Ayodele and Robert. So, I mean, you're absolutely correct. And you guys are fantastic. So, I mean, I would have expected that you'll have told me that, okay, let's share that 10 million to those individual assets on a pro rata basis. I mean, that is idealistic. Let's share it on a pro rata basis. And when we say pro rata basis, is based on their individual values, which I will show you guys. Based on their individual values, then you use it to prorate the impairment loss to each of them. But Ayodele give more insight to it, and is absolutely correct. Because when you're carrying out this, when you want to share this impairment loss, because there are a group of assets here, so you need to do some prioritization. You have to prioritize certain assets because we believe that since there are a group of assets, there's like one or two assets will have actually caused that impairment. They cannot contribute to those impairments equally based on their values. One or two will have been the cause. One or two of the assets will have affected the entire system. So, and the very first point of call is an obviously damaged asset or a physically damaged asset. So if there is any asset in that group that the examiner tells you is damaged, we believe that is the one that will have caused that impairment loss. That is the one. So we prioritize such an asset that we will need to impair that to zero first. To zero first. Then we also prioritize goodwill next. That's the next one prioritize in allocating this impairment because we believe that if goodwill belongs to a group of assets or to a CGU, you know, so we believe goodwill, and if that CGU is impaired, the first thing, if there is no asset that is damaged, then the next one that we're going to suspect is causing impairment to our business. If you are saying CGU as a business now, because when goodwill is involved, that means it's a business you are actually talking about. So, so we believe goodwill will have been the cause of why our business is suffering impairment, because impairment loss means it's like a permanent diminution in value. It's permanent, right? So it's goodwill. That means one of your staff has messed up, or one of your products has seriously underperformed, and everybody is calling you out on social media. Your goodwill has suffered. So we believe goodwill is the next one that we should prioritize. Those two in that order. I mean, if in a question, you have physically damaged assets and you also have goodwill, you prioritize physically damaged assets in such a way that if the value of the physically damaged asset is, let's say, 5 million, and the impairment loss from that entire CGU is 5 million, give the entire 5 million to that physically damaged asset. That's what I mean by prioritization. So you need to write it off to zero first. Then you write goodwill to zero. Then if the impairment loss is still remaining after those two, then you can then share that impairment loss to other assets, especially non-current. In fact, basically other non-current assets on a pro rata basis. And that is the entire gist for CGU. Let's solve the question. Minimart belongs to a retail store chain, Maximart. Minimart makes all its retail purchases through Maximart Purchasing Center. pricing, marketing, advertising, and human resource policies, except for hiring Minimat cashiers and salesmen, are decided by Maximat. Maximat also own 5 other stores in the same city as Minimart, although in different neighborhoods, and 20 other stores in other cities. All stores are managed in the same way as Minimart. Minimart and 4 other stores were purchased 5 years ago, and goodwill was recognized. Required. What cash generating unit does Minimart belong to? Okay. Now, looking at this question, they are talking about Minimart. This question is asking us that what cash generating unit does Minimart belong to? So the first thing is, what is Minimart? We need to understand what is Minimart from this question. So Minimart obviously is a branch of a supermarket. So like there's a huge supermarket, Maximart, that has several branches, right? And from here, this Minimart makes all its retail purchases through the Maximart purchase center. Pricing, marketing, advert, human resource are decided by Maximart. Maximart owns 5 other stores in the same city as Minimart and 20 other stores. I mean, the whole thing here, Minimart is just a store, is a supermarket. That's what Minimart is. So what cash generating unit does Minimart belong to? Minimart does not belong to any cash generating unit because Minimart itself is a cash generating unit. Because Minimart is a supermarket, is a branch of a supermarket. And any business, any item in reporting that you can know how much that unit is making, that okay, how much have we made today? And we can see, okay, we have made 100,000. That is a CGU. Whatever that thing is, in as much as we can trace to it how much it makes, either per day or per month or per annum, is a CGU. Minimart being a retail store or a branch of a retail store, of course, they will know how much it makes every year, every day, every month. So whatever policy management is making on its behalf is not relevant here. What is relevant for us is that can we attribute certain amount of money being made to Minimart? Can we say Minimart has made so much this month? Can we say Minimart has made so much this year? If the answers to that are yes, the Minimart is a CGU. So, and that's the solution to this question. So this question, I mean, wants to expand your mind about what CGU is. So CGU is not, don't see it as a random group of assets that they put together. In fact, CGU is a business, mostly a business. In the exams they will give you to be a business. So a business that will have different assets. And most businesses, you find out that those individual assets, you cannot say this is how much they make individually, except you look at the entire business as a whole, right? So that's CGU. Minimart is a CGU. Next, let's look at another question. So, okay, let's look at this question. It says a cash generating unit comprises the following: building, plant and equipment, goodwill, current assets. Following a recession, an impairment review has estimated the recoverable amount of the CGU to be 25 million. How do we allocate the impairment loss? Okay, so they give us a CGU, and these are the assets in the CGU. Obviously, these are the carrying amounts. So they did an impairment test. So the CGU recoverable amount, the recoverable amount of the CGU is 25 million. So of course, the carrying amount is higher than the 25 million. So the impairment loss is 8 million. So this question is basically interested in how do you allocate the impairment loss? So how do you share this 8 million? Just like the question I asked you guys earlier. Of course, you debit the 8 million to P&L. So, but when you are crediting the assets, you can't credit CGU because CGU is not an asset. You credit the individual asset, right? This question, we do not have a physically damaged asset. Okay, we do not have a physically damaged asset. So that means we're going to prioritize goodwill. Then we're going to prioritize other non-current assets. We're going to ignore current, right? Reason because current asset impairment is quite different from impairment of non-current assets. Like what we did in IFRS 9. So it's if trade receivables belong to this current asset now, the way we impair trade receivable is quite different from this approach that we are looking at here. Inventory, for example, if inventory is part of this current asset, the way inventory is impaired is different from this. So impairment of most items in current asset are dealt with in other standards. When you have a question on CGU, leave out the current asset. If current asset belongs or is part of that CGU, just ignore it. Except the examiner specifically tells you that the current asset has been impaired. Except the examiner specifically tells you that the current asset has been impaired. That's the only situation where you're going to consider current asset. But in this question, we ignore current asset. So how do we allocate this 8 million? So I will use this table. Okay. So the carrying amount, the impairment loss, the carrying amount after impairment loss. So these are the list of the assets. So first is goodwill. Goodwill value is 5 million. I'm going to allocate 5 million of these 8 million to goodwill. So the value of goodwill becomes 0. The remaining 3 million, I will share it between building and plant on a pro rata basis. So the value of building is 15. The value of plant is 3. So that's a total of 18. So building will get 15 over 18 times the remaining impairment loss. If you punch your calculator, that gives you 2.5. Plant and machinery will get 3 over 18 times the remaining impairment loss, and that gives us 0.5. So we take it to the table, building 2.5, plant and machinery or plant and equipment 0.5. So 15 minus 2.5, that's 12.5, and 3 minus 0.5, that's 2.5, okay? So for the current assets, you are not going to allocate any impairment loss to it, so it still remains 10. And that is the entire, and that's how you allocate impairment loss to assets in a CGU. Okay, so that's that. So now, impairment can reverse. Impairment can actually reverse. So an asset that has suffered an impairment loss, in subsequent years, things can change. All prices might start picking up, then the value goes up again, right? So that's a reversal. So reversal happens when values of assets goes up. However, the only thing I just need you to note for reversal is this. Please pay attention to this. So let's say before impairment, the value of an asset is 10. So you impaired. You say impairment loss is 2. So you wrote it down to a recoverable amount of 8. Right? So next year, you now said, okay, there is a reversal. You say there is a reversal, and that the value has gone up to 12, right? IAS 36 is saying that this reversal will not work. It will not work up to 12. That you can only reverse up to the point of 10. Up to 10. It cannot go up to 12. Because we don't expect the value of your asset to go up beyond its original value before impairment. it should not go up beyond its original value before the original impairment. So your assets impaired from 10 to 8. You're not saying it has gone up to 12. No, you cannot go more than 10. So when you are reversing impairment loss, you only reverse back to its original value before original impairments. I need you to note this and never forget. It will come out in your exam, so attend to it. So the double entry for reversal now. You can tell me the double entry for these two now. Anybody?
It's on a board. Oh.
What's the reversal?
Reversal of the. No, I'm saying the answer. You've written. You are showing us the answer. The reversal of the impairment loss should be recognized immediately as income in profit or loss.
Oh, congratulations. So that's credit to POL. Where will the debit go?
The assets.
Good. Now, disclosures. So you need to disclose the impairment loss recognized in P&L for the period. You need to tell us. You need to tell us if there's any reversal, if the impairment loss is on the revalued assets that have been recognized to OCI. You need to tell us. And this other information, just these are additional disclosures that are required in the notes to the account. Now let's solve some past questions. So there are two past questions here, and I hope to look at the two. So now let's look at this first one. It says that as a result of privatization and commercialization exercise currently going on in the country, the Ministry of Transport sold the assets and liabilities of the newly constructed standard gauge railway to a private company known as Talos to ensure smooth operations of the railway services by freeing it from government bureaucracy. Okay, so I'll be analyzing it paragraph by paragraph. So this paragraph is saying that government has sold the railway stations to Talos. That's that. The second paragraph, they say the summarized extract of the statement of financial position at fair value of SRL on January 1st, 2019, reflecting the terms and conditions of the sales agreement of the Transport Ministry. Okay, so now this is the asset and liabilities of that railway station. So I mean, since Talos has bought it, so it becomes the asset of Talos. So these are the assets, goodwill, and all of that. This purchase consideration, of course, is the addition of all of this. This will have been the amount Talos paid to the government, but these are the assets. Okay, next paragraph. The license is for 10 years. The issue date on January 1st, and it is at cost. The carrying value of the property and road tracks and coaches are based on value in use. The engines are valued at their net selling prices. Okay. Good information, very useful information. We'll use them very soon. On February, one of the train engine got damaged, okay, due to technical faults from the manufacturer, and the engine was completely destroyed. Okay. The sale of the asset to SRL was without recourse to the Transport Ministry and manufacturer of the engines. So that means Talos cannot go to the government and say, this train I just bought from you guys, so the engine don't spoil, oh, give me back my money, oh. It won't work. It is without recourse. It is without recourse. They cannot go back. In view of this, it was estimated that there would be a reduced passenger capacity. Therefore, the estimated value in use of the old train service was assessed to 1.5. Okay. A train that we pay 2.24 or that is what 2.2 now is 1.5. Interesting. Furthermore, so the number of passengers after one of the twin engines got damaged was below expectation, even allowing for reduced capacity. In the light of this, the value in use of SRL was reassessed on March to 1.3. Wow. Again, further reduction. In February, it was 1.5. Things are not working out. Now it is 1.3. Okay. On this date, SRL received an offer of 675 from another company called Papaya for the operating license. Okay, so somebody came and said he wants to buy the license for 675. This is transferable. All right, so the realizable value of other asset has not changed significantly. Required. Draft a memo addressed to the MD of Starlux Railway Limited, explaining the basis of allocating an impairment loss to the asset of a CGU in accordance with IAS 36. B, calculates the carrying amount of the asset of SRL Limited at February and March. C, explain two conditions that must exist before an impairment loss can be reversed. Okay, so draft a memo. I mean, when they say draft a memo, you just draft a memo, and majorly it's just the body, the name, the title, form, to subject. There will be date, of course. Then you just write whatever. Then you're going to close with thank you. So basically, what the body will have end like maybe it's the format of the memo. The memo format will have end you like 2 marks. Then the body itself will do the remaining 4 marks. So, and what's the body about? Is allocation of impairment loss, the basis of allocation. And you already know that the first is to a physically damaged assets, next is to goodwill, then next is to other assets on a pro rata basis, right? And if the examiner specifically mentioned that current asset has been impaired, then you allocate impairment loss to it too. And I mean, one thing I've not mentioned that you are going to see in this question is that when you are allocating impairment loss to assets in a CGU, you have to be very careful so that you will not defeat the purpose of this standard. Ensure that that impairment loss you allocate does not reduce the assets below its recoverable amount. So you have to be very careful with that, and which is part of what this question is testing. So that will give us 6 marks. Now, calculate current assets of SRL at February 1st, 2019 and March 1st, 2019. Okay, so you see, the thing is this, when they ask this question, I mean, a lot of students didn't even know that what they wanted is impairments, especially in this B, when they just say calculate carrying amount. Knowing fully well that carrying amount is cost minus accumulated depreciation minus accumulated impairment losses. But here now, depreciation is not present here. It's only impairment loss. Because the question didn't even mention anything around impairment loss. But students that understand what a CGU means, that CGU CGU is a business. When we have a business, it's a CGU. And when a question is already giving you value in use of an entire business, that means they want you to impair. They want you to impair. When they are giving value in use of the entire business on 2 occasions, they gave us in February, they also gave us in March. And if you look at the question, they want you to calculate carrying amount in February and in March, which is on the 2 occasions they gave us those recoverable amounts. So let's quickly do it. Very straightforward question. So on the first occasion, which is the February now, because the value of the asset is now 1.5 as against 2.2 it was. Okay, so this, of course, is the carrying amount. This is the recoverable amount. There's a difference of 750. That 750 is impairment loss. We know that impairment loss will go to P&L. But you need to allocate that 750 to these assets, all these other assets, based on the basis of allocation we learned. And of course, in February, one of the engine was damaged. So we already know which one would prioritize. We're going to prioritize the engine in allocating impairment loss, then goodwill, then other assets. So here there are two twin engines whose value is 750. So if two twin engine value is 750, that means if only one got damaged, so we're going to then divide this 150 into two. So that means each of them is 375. So we allocate 375 to the one that got damaged. So let me show you the allocation. So look at it here. So in February, these are we allocate. These are the carrying amounts of each of those assets. So first is the train engine that got damaged. So the total value is 150, but only one got damaged. So we allocate 370. We totally write off that. So we allocate the entire 375. So remaining the one train engine. Then of course, the next one is goodwill. Since the impairment loss is 750, so it's a lot. So we can accommodate the entire goodwill. So nil. So we're going to then allocate the remaining value to other assets on a pro rata basis. To other assets on a pro rata basis. And what are the other assets? Operating license, property stations, road tracks, right? So we're going to allocate it on a pro rata basis. And this is the workings for pro rata basis. For operating license, it will be 900 over the value of the license and the two other assets multiplied by the remaining impairments. So we are allocating 150 to license. To property stations, the same mathematics. We are allocating these amounts. Then rail tracks, we are allocating these amounts. And that is where we got these 150, 375, and 375. Then these values are this. Any questions? Any questions? Okay, no questions. So I'm going to ask you a question. So now, they told us that one of the twin engine got damaged. So we totally impair that one. Then we move to goodwill. Then we now do allocate to the others on a pro rata basis. So when I was allocating to the others, I only allocated to these three. I ignored the remaining one twin engine. Remember, there are two twin engines. So why did I ignore it? Of course, that means you understand it since you refuse to ask. So tell me, why did I not allocate impairment to the remaining one twin engine? Because we said we are going to allocate impairment to the remaining on a pro rata basis. So why didn't we allocate to the remaining one twin engine? Anybody?
Is it because they are together, in which case the 375 is already an impairment for the twin engines as an aggregate? So to
No.
come and prove it
It's
for another one
375.
again, it now looks like a duplication.
No,
I'm
no,
just
that is
thinking
not.
aloud.
No. The the 375 is for the one twin engine that was damaged.
Yeah.
It's that one clear. So
Yeah.
So there's still remaining one twin engine. Okay, see, the reason is that you see, this twin engine is already valued at its recoverable amount. So, and the aim of impairment loss is to write down the carrying amount to its recoverable amount. So, although one of the twin engine got damaged, but the remaining one, which is the 375, it's already at its recoverable amount. So we cannot impair for that. You don't impair below recoverable amount. So you need to be very careful. And how did I know that?
The market price less cost. Okay.
Yeah, the question told us that the engines are valued at their net selling prices.
Yeah.
So you need to be very careful. When they tell you that, that means you cannot impair for that. You cannot impair for that. And that's the only reason. So that means, guys, you need
Yeah.
to listen better. If I hadn't mentioned it, you just have assumed that, okay. But ordinarily, if they hadn't mentioned that in the question, you will have allocated. If they didn't tell us that the engines are measured at their net selling prices, you will have allocated to that remaining one twin engine too on a pro rata. The only reason why we left it out is because it's already the recoverable amount. It's already that's the selling price. So you cannot impair below that. No, it's not possible. Okay, so
You know,
that's
you
in
mentioned it in when we were doing a financial instrument, fair value through profit or loss. Because
exactly,
the one that is done through profit or loss, because of the fact that it is trading, so is
exactly.
always being yes, is always being aligned to market value. So based on that, the treatment is yeah, I recall now.
Yeah,
I recall.
yeah. Okay, so that's February. So let's move to March. So what happened in March? Um, so in March, what happened? What happened? Okay, this March. So in March, so they saw that things are not still going as planned. So they now gave us the value in use of the entire train station to be 1.3 now. Then somebody came and said he wants to buy our license for 675. Okay, that was all. So that means there is a further impairment loss from 1.5 in February to 1.3 in March. That's like 150, like around 150 billion. So let's allocate in March. So from February now, these are the new values of those assets. These are the new values of those assets. So we bring them to this table here, the new values, the new values. So the total impairment loss now is 150. So in this March, we don't have any physically damaged assets. We don't have goodwill. So it is expected that we allocate to other assets on a pro rata basis, except where any of these values is already at their net selling prices. In that case, you cannot impair for that. And that is why this train engine of 375, I didn't allocate any impairment loss to it because it has its net selling prices. So it still remains at 375. I can't impair below that. Secondly, since someone came to buy the license, um, they want to buy it at 675. That means that 675 becomes the recoverable amount of that license. I cannot impair below 675, right? So in fact, that obviously means that the value of the license has fallen from 750 to 675. So the difference between this 750 and 675 which is 75, automatically becomes the impairment I will allocate to the license, right? So out of this 150, the license automatically takes 75 as a result of the fact that the question told us that the net selling price is now C75. So I need to write it down to exactly that amount. And that is why it's taking 75 out of 150. Now, the remaining 75, I will then share it to the other assets on a pro rata basis, and which is property and road tracks. As you can see, they are the same values. Just divide the 75 by 2. So that's why they are having 37.5, 37.5 impairment allocation. So these are the new values of our assets. These are the new carrying amounts of our assets. Okay, so what I see in this question, this 10 marks part I've taught you is basically that when you are allocating impairment loss to assets in a CGU, care must be taken to ensure you don't impair an asset that is at its net selling prices any further. So the best you can do is that if the net selling prices is below the book value, then just impair it exactly to that value. Don't allocate on a pro rata. No, to such. Indeed, you can see how we carefully brought down the 750 to the 675 given to us in a question that some people came and they want to buy the license for 675. That becomes the net selling price of that license. So we allocated 75, enough to bring it down from 750 to 675. Okay, and that's the major thing this question has taught us. Now, the other part of the question is asking the conditions that must exist before impairment loss can be reversed. So, of course, there must be an improvement in indicators of impairment, and the reversal should not lead to carrying amount in excess of what the carrying amount of the assets will have been without the original impairment loss. I think I explained this to you. So you cannot reverse beyond the original value of the assets before impairment. You cannot reverse beyond that. And that's what this point 2 is talking about. And that's the end of this question. Okay? Now, so here's another question. It says that an asset is said to be impaired when its recoverable amount is less than its carrying amount in the statement of financial position. From time to time, an asset may have a carrying amount that is greater than its fair value, but this may not necessarily be impairment, as the situation might change in the future. Impairment means that the asset has suffered a permanent loss in value. There are many factors that can affect the quality of impairment accounting and disclosures required. Discuss with particular reference to group accounting the 2 factors which would be important when conducting impairment tests under IAS 36. The 2 factors which would be important when conducting impairment tests in IAS 36. Can anybody attempt this question? The 2 factors when conducting impairment tests. What are the 2 factors?
That is what you had mentioned before, carrying amount and recoverable amount.
That's correct. Okay. Those are the 2 factors. Now, you see, this question is an 8 marks question. And they say that discuss with particular reference to group accounting. Discuss with particular reference to group accounting. So how do you discuss with reference to group accounting? Because that means you have to discuss carrying amount, you have to discuss recoverable amount. So let's start with carrying amount like this. So how do we discuss carrying amounts with reference to group accounting? What can we, because carrying amount is just the amount you recognize your assets in your books, deducting accumulated depreciation and accumulated impairment losses. So, but this question says with particular reference to group accounting. What other things can we add? Anybody? So what you can add is this. So in the exam, I mean, uh, especially reporting that is principle based, you just have to be, if you understand the core principle, then you'll be fine. So for group now, when you're saying the carrying amount of a group is the carrying amount of the parent and the carrying amount of the subsidiary. And that's all you need to tell the examiner. That in a group account, after you have explained what carrying amount is, you now say in a consolidated account, the carrying amount of the group is the addition of the carrying amount of the parent and that of the subsidiary. You have made reference to group account. Then for recoverable amount, you need to tell the examiner that recoverable amount is the higher between fair value less cost to sell and value in use. Then you explain what fair value is. You explain what value in use is. Then you tell them that the fair value of a group is that of the addition of the parent and the subsidiary. The value in use of a group is the value in use of the parent and that of the subsidiary combined, like that. Then that will have earned you 8 marks. I have the solution here for you, so you can just read it up. It's all here, all for you. Now, that's the first part of this question. The second part of this question, which is the B part, talks about Pepenepe PLC. Okay, this is another question entirely. Okay. Pepenepe PLC, he said, is an entity that regularly purchases new subsidiaries. And also on June 2019, the entity acquired all the ordinary shares of Bobo Nigeria Limited for cash payment of 390 million. The net asset of Bobo Nigeria Limited as at acquisition date is 270, and no fair value adjustments were necessary upon consolidation of Bobo for the first time. So this paragraph is saying that this company in consideration acquired another company and paid 390, and the assets of that company it acquired is 270. Obviously, the difference is goodwill. The difference between that 390 and 270 is goodwill in the consolidated account. Okay, next paragraph. It now says on December 31st, 2019, Pepenepe PLC carried out a review of the goodwill on consolidation of Bobo Nigeria Limited for evidence of impairment. The review involved allocating the net asset of Bobo Nigeria Limited into 3 cash-generating units and computing the value in use of each unit. Okay. So on December, Pepenepe carried out a review of goodwill for evidence of impairment. So, I mean, this question specifically told us that Pepenepe is trying to see if goodwill has been impaired. And that makes sense because I told you already that goodwill acquired in a business combination is tested for impairment annually. So it's logical for this guy to want to see if the goodwill has impaired at the end of the year. It's expected. But The review that he did involved allocating the net assets of Bobo, that is the subsidiary, into three CGU and computing value in use in each unit. So he separated this company into three CGU. It must be a very big company. So CGU1, so they gave us the details anyway, CGU1, CGU2, CGU3. So these are the assets in each of the CGU. Of course, this will be the carrying amount, and this is the total. And they also gave us the value in use, which I will see as the recoverable amount of each of the CGU. So I can easily know the impairment loss in each of the CGU now, because just the difference between this and this in each of the units give me my impairment loss. Okay, let's go to the next paragraph. It states further that it is not possible to allocate the goodwill on consolidation to the individual CGU. It is not possible to allocate the goodwill on consolidation to the individual CGU. But other net assets of Bobo are allocated in the table above. Okay, so they are saying the CGU belongs to the entire business. So there's no way for us to say that CGU belongs to each of these units. So it's not possible, but it belongs to all of them together. That's what they are saying there. Now said patents, that is this patent of Bobo Nigeria Limited have no ascertainable market value. What does that mean? In fact, it means that this patent, write it off completely. If they say that this value in the books, it has no ascertainable market value, that means they're telling you that the recoverable amount is zero. So in fact, that's one that you should prioritize. That means it's gone. Allocate, write it off completely. Now, they now said, but all current assets, because they give us named current assets here, all current assets have a market value that is above their carrying amount. So that means when you're allocating impairment, don't bother allocate to the current assets because they are not impaired. Their market value is above the carrying amount. So don't bother yourself with those ones. Furthermore, they said the value in use of Bobo Nigeria Limited as a single CGU at December 31st is 307.5 million. Okay, so the CGU of the entire CGU, the value in use of the entire everything combined is 307.5 million. Okay, this is quite informative. Now, required, discuss how impairment loss in Unit 1 will affect the carrying amount of the net assets of Unit 1 using relevant figures as illustration in a consolidated financial statement of Pepe. Discuss how impairment loss in CGU 1 will affect the net assets of Unit 1. Discuss. So I'm reading it again because all the question want us to do is discuss with relevant figures how impairment loss. So all they want you to do is to explain how you determine impairment loss in CGU 1. Discuss how the impairment loss in Unit 1 will affect the carrying amount. So get the impairment loss and allocate it. So they just want you to get the recoverable amount of Unit 1. That's how the impairment loss will affect. So the impairment loss of Unit 1 is this 127 minus 108. Is there anybody there with calculator? What is 127.5 minus 108?
19.5.
19.5. Okay. Now, that 19.5, we will need to then allocate it to the asset in unit 1. So from the question, we already know that the patent is going to get 7.5. The patent is going to get 7.5 straight on. The remaining 12.5, it cannot go to net current assets because they told us it is not impaired. That means it will most likely go to the PP, right? So let's see. So we explained, we discussed it here first because the question says we should discuss. So we need to explain how it will affect. That was how I explained the order of allocating impairment loss to CGU, physically damaged assets, goodwill, and other assets on a pro rata basis. Okay. So I then went ahead to explain that the impairment loss will be allocated first to patents because they told us it does not have market value, and the remaining will go to plants. And I also told them that the net current asset is fair value is higher than its carrying amount, so we cannot allocate impairment loss to it. And I did some illustrative figures. So the patent received 7.5, then the remaining went to the PP, which brought it down to 78. We didn't allocate to the net current asset, so it still remains its original value. And that was it. And this is how we got the impairment loss, this minus the value in use. So, and that's how we would allocate the impairment loss to CP1. Now, the second question says, calculate and explain the effect of the of Bobo Nigeria Limited on December 31st, 2019. Calculate and explain the effects of the impairment review on the carrying amount of the goodwill. So how do you attend to this? So this one means that the entire business needs to be, we need to then determine the impairment loss on the entire business. And also, we will then allocate impairment loss to the entire business. Just please give me a few seconds. So, how do we achieve that? Just like we have done before, I did some explanation first, how impairment loss is allocated to CGU, to physically damaged assets, to goodwill, and then to other assets. And I told them that the CGU1 that we did before, that had an impairment loss of 19.5 already. So the CGU2 and 3, that one hasn't suffered impairment loss. But as far as CGU1 is concerned, from the solution 1, we know that there is a 19.5 million impairment loss on that. So the entity-wide impairment loss will be allocated to CGU, which is the CGU1, then to goodwill, then to other assets. So I took each of those CGU, I got their total values. The addition of this, addition of PP, addition of non-current assets, which is 420. Then the question already gave me the value in use of the entire CGU of the entire bubble, which is 307.5. Then my impairment loss is 112.5. So this impairment loss, I will then allocate it to these other assets. I will allocate it to the assets on a pro rata based on the order. And the first one would be this patent that we already know has been damaged. It has no ascertainable market value. Then the PP will get 12. That's the 19.5 from CGO1. Then out of this 112.5 impairment loss, that means we have already distributed 19.5. That means it will remain 93. So the 93 will go to goodwill. So goodwill will then reduce from 120 to 27. Then this one no more. This one will reduce to 183. Nothing has touched this particular guy, so its value remains unchanged at 97.5. So you see that the way they have solved this question too is in such a way that the CGU1 was seen as the damaged asset, because from the solution one, we already know that there is an existence of a 19.5 impairment loss attributed to CGU1, which was why these two went to CGU1. Then the 93 was taken by goodwill. Okay. So, and that's this question. That's this question. So there are a whole lot of, there's one other one here, but this is a very straightforward one. There are a whole lot of questions, on impairments. Hopefully I'll be able to send you like 4 or 5 of them for you to solve. But it's an area ICANN would ask you. It's an area you need to be ready for in the exam. So that's the end of impairment loss, IAS 36. This is the time you can ask any questions you have.
So it's not really a question, but like a reminder, kind of. You said you will send us questions on, like questions to solve on IAS 19, that is employment benefits. We've not seen that yet. And even on financial instruments. So I don't know.
I will send it. I will definitely send it. I will definitely send it. I will send it. I will send it this month. Not that I'm being defensive, but you know that the one I sent to you, really like only one person have done that. The one I've sent to you on IFRS 2. You're supposed to send it to me so you can have the solution. A lot of you don't have the solution. And you did not ask. So let's even assume I've bombarded you with the other ones. It will just be there. It will just be there. You will not look at it. We have not done leases, so we are still going to come back to lease. But for now, we need to move to IFRS 15 on revenue from contract with customers. Can we continue?
Yes, please.
Okay. So I need you to stay alert on this particular one because this is a new topic now. So revenue from contracts with customers. So this standard majorly deals with revenue, and revenue is usually the first item in the statement of profit or loss. It usually comes first in the statement of profit or loss, and it is considered to be the measure of the size or the growth of a company. So when you want to know whether a company is doing very well or not so well, the first area you consider is, okay, how much is it making? What is its revenue? And most importantly is that revenue is always like the biggest or the largest amount in the statement of profit or loss. So revenue is so important that it has to be stated correctly in the books. And IFRS 15 is here to make that a reality. It came in 2014. It's a joint project between the IASB and the FASB, and it came to replace IAS 8, IAS 18, and IAS 11. It came to replace them. So one of the reasons they came up with IFRS 15 is the fact that the previous standard on revenue were not able to close some gaps in false invoicing and recording fictitious revenue. So there was a lot of gap that or loopholes that people were taking advantage on in recognition of revenue. But with IFRS 15, it has covered most of those loopholes. So, and the guidance here is very extensive. It's extremely extensive. Okay, so we'll be looking at the objective of IFRS 15 first, the recognition criteria, measurement of revenue, contract costs, presentation and disclosures. So the objective of this standard first is to ensure that revenue recognized in the statement of profit or loss depict the consideration expected by the entity from the transfer of promised goods or services to customers. Let me stop here. So the objective of IFRS 15 is just to ensure that the revenue that you recognize in your POL, the revenue you recognize in your POL must depict, what it must show must be the consideration you are expecting from the transfer of promised goods or services. Are you awake? The revenue you must recognize in your P&L must be the consideration you are expecting from the transfer of promised goods or services. See, what this means is that when it comes to this standard, we are saying revenue you can recognize is only based on the goods or services you have transferred. You cannot recognize revenue until you have transferred goods or services. So revenue in POL must depict the consideration you're expecting from the transfer of goods or services. So when you do that, you're going to provide useful information to users about the nature, the amount, the timing, and the uncertainty of revenue and cash flows arising from a contract. So it helps because we'll be able to know the nature, what type of revenue you're talking about, the amount, timing, and all of that. Okay, that's the objective. So have that in mind. Then how do you recognize and measure revenue? There are 5-step model towards recognition of revenue now. 5-step model. The step 1 is to identify the contract with customer. That's step 1 in revenue recognition. Identify the contract with customer. So the major thing here is that, of course, there has to be a contract. And IFRS 15 says that a contract is an agreement between 2 or more parties that creates enforceable rights and obligation. A contract is an agreement between 2 or more parties that creates enforceable rights and obligation. An agreement. So, and when we talk about a contract, for it to be within the scope of IFRS 15, it must have the following. So I kind of asked this particular one, I mean, 2 consecutive diets, or I think 5 or 6 marks, that what are the criteria a contract must meet for it to be within the scope of IFRS 15. So number 1 is that the parties must have approved the contract, either in writing, orally, or in accordance with other customary business practices. And of course, they are committed to carrying it out. So that's the first criteria. They must have approved it. Of course, if they don't approve it, that cannot be a contract in line with IFRS 15. Number 2 is that each party's right regarding the goods or services to be transferred can be identified. Each party's right regarding the goods and services can be identified. So each parties must know what they are doing. The person that is supposed to transfer goods should know. The person that is supposed to pay money should know. So each party's right regarding the goods or services to be transferred can be identified. Number 3 is the payment terms for the goods or services can be identified. The payment terms must be very clear, right? Because the whole essence of selling is to collect money, is to make money. So when we are going to be paid is very important. It must have been identified. Number 4 is that the contract must have commercial substance. Okay? Because that's when we are serious about the contract, when there is commercial substance, when people are paying. And when we say commercial substance, it means the risk, the timing, or the amount of the entity's future cash flows is expected to change because of the contract. That's when there is commercial substance. Money must change hands. There must be risk involved. Okay? So it is not every time you enter into a contract that would be a contract. You can enter into a contract with a related party, maybe with your wife or your child or your siblings. It might not have commercial substance. That whether it pays or not, nobody would be sued. Nobody will face any consequence. Nothing will happen. There's no commercial substance. Next is that it is probable that the entity will collect the consideration to which it will be entitled. We have to be sure that we'll collect our money. And the contract can be written, oral, or implied. So you have to know these six, because these six must exist before we can say a contract exists in line with IFRS 15. When you have a contract that does not meet the above criteria, you now went ahead to receive money from a customer, you cannot recognize such money as revenue. In fact, you can only recognize it as a liability, because we believe that when all of these are not present, that means the customer can come back and say, please give me back my money. Because when you guys haven't agreed payment terms, you have not agreed each party's right regarding the goods or services. You have not approved the contract. So that means the guy just borrowed you money. He just gave you money. You can come and collect it. So that's why we are saying that when the above is not met, then you can only recognize a contract liability. That is, you debit bank, you credit a contract liability. However, if it now happens that you collected the money and for whatever reason you have no remaining obligation to transfer any goods, or the money you collected is non-refundable because the contract has been terminated, in those cases, then you can recognize revenue. Good for you. That means that money is a free money for you. So you recognize revenue and you move on. Okay. Furthermore, it's possible that we could consider possibility of combining contracts together, especially when you have two or more contracts that you enter at almost the same time with the same customer. Then you should consider combining them. When you have two or more contracts that you entered into with a customer, with the same customer at almost the same time, consider combining them if they meet the following criteria. Number one is that if the contract are negotiated as a package with a single commercial objective. So if you actually negotiated them together and each of them is for a single objective, is just imagine you negotiated a contract to build a structure, maybe whether a hospital for somebody, but you have done it in such a way that there is a different contract for the foundation, there's a different contract for the structure, for the finishing, like that. But you will have if you have negotiated it together and you agree that they have a single commercial objective. So just see those entire contract as one. See them as one. Don't see them as separate contracts because they're actually one. Also, if the amount of consideration to be paid in one contract depends on the price or performance of the other contract. So if the price or amount to be paid in one depends on when you have done the other, so that means you must finish one before you can move to the other or get paid in another. So that means they are a single contract. Just combine them together. And thirdly is that the goods or services promised in the contract can be delivered as a single package. Can be delivered as a single package. So if these three criteria are present, then consider the possibility of combining the contracts. Another one is contract modification. So contract modification occurs where there is a change in the scope or price of a contract that is approved by the parties to the contract. Contract modification occurs when there is a change in the scope or price of a contract that is approved by the parties to the contract. Now, when there is a change in the scope or change in the price of a contract, are you going to account for that change as a separate contract? Or you are going to see that change as part of the original contract? Now, this standard is saying that you should see it as a separate contract if the following conditions are present. Number one, if the scope of the contract increases because of the addition of promised goods or services that are distinct. The key word there is distinct. That is, the change in scope, the increase in scope is because of addition of promised goods or service that are distinct. So the major thing here is that when is a good or service said to be distinct? When is a good or service said to be distinct? We're going to get there, so you just have to be patient. The second one is the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. So again, the price of the contract increases by an amount of consideration that reflects standalone selling price of the. And what we mean by standalone selling price is the price at which the entity would sell a promised good or services separately to a customer. So that's how much you would ordinarily would have sold your additional goods or services or a good or service to a customer ordinarily. So if a modification now change price by that amount, just treat that modification as a separate contract. Treat it as a separate contract. Okay, so these two criteria are very important. Okay, just for clarification, look at this scenario. They say that an entity promises to sell 120 products to a customer for 12,000 naira, so 100 naira per product. The products are transferred to the customer over a 6 months period. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is then modified to require the delivery of an additional 30 products, so a total of 150 identical products to the customer. When a contract is modified, the price of the contract modification for the additional 30 product is an additional 2,850 or 95 naira per product. The pricing for the additional product reflects the standalone selling price of the product at the time of the contract modification, and the additional products are distinct from the original product. Does this contract modification constitute a separate contract? Okay. So where does the modification enter now? Because this contract is that, okay, we want to sell 120 products to a customer at 100 naira per product, so 12,000 naira, and over 6 months. So we transferred 60 first. Then the customer now modified and says that, okay, he wants to expand the scope, that he wants more than 120, that he wants additional 30. So bringing the total to 150. So they now say that the price for the additional 30 is 95 naira per product. They now said the pricing reflects standalone selling price. Don't forget, where the increase in price reflects standalone selling price of additional goods. That means you are treating it as a separate. So this question already told us specifically that the price of the additional goods is a standalone selling price. Okay. And they also say the additional product are distinct from the original product. Don't forget, where the change in scope is because of additional promised goods or services that are distinct. So this question has already given us the two criteria that must be met already. So does this modification constitute a separate contract? Yes, it meets these two criteria. So the request for additional 30 products, we're going to treat it as a separate contract because the scope increases because of additions of promised goods or services that are distinct. The price of the contract increases. It reflects the standalone selling price of additional goods or services. So it's a separate contract. Now, let's assume, because this question was very direct, I intentionally set it like that because I haven't explained what distinct is. So that's why I mentioned distinct. So in the exam, they will probably have explained through a scenario what distinct is. But you are still going to know what distinct is in step 2 that I'm moving to now. However, so I just want to, I've solved this question. So I just want to explain something to you here. That what happens if the additional 30 products, like if the price of the additional 30 products does not reflect standalone selling price, right? So that means that the contract modification will not be a separate contract. It's not going to be a separate contract. That means that modification would be a termination of the original contract and the creation of a new one. So that means is a new contract entirely. So we're going to create a new contract for the entire 150. We're going to terminate the original. So you just need to have it in mind that when it comes to contract modification, it can result in either having a separate contract, it can result in the termination of an existing contract. I mean, if it doesn't meet the criteria we mentioned above, and can also result in the creation of a new contract. Okay, and I did some calculation how we're going to recognize the remaining revenue, which is quite straightforward. The remaining 60 products at 100 naira, the extra 30 products at 95 naira, like that. Okay, so that's step 1. So the whole of step 1 that you need to know these 6 criteria. You need to know what contract combination is, and you need to know what contract modification is. Now, step 2, identify the separate performance obligation. So after we have identified a contract, and we see that, okay, a contract exists, then the next step is to identify whether a performance obligation exists. You identify the performance obligation. And usually, what you will find in a contract is a promise to provide goods or services to a customer. You see, those promise to provide goods or services is what we call performance obligation. Includes promises to transfer goods or services, is what we call performance obligation. And when you are recognizing revenue, what you account for is, of course, the goods or services or the performance obligation you are providing or transferring, but you are going to account for each good separately, and you account for them separately only if those goods are distinct. Now we are back to distinct again. Distinct. So this step 2 is just saying that identify the goods or services you are providing and ensure that you account for those goods or services separately if they are distinct. And when I say distinct, what distinct means is that goods or services can be sold separately because it has a distinct function and a distinct profit margin. Because it has a distinct function and a distinct profit margin. So then that is what we mean by distinct. So when we say distinct function, it means that the goods or services that the customer can benefit from that goods or services on its own or together with other resources that are readily available to the customer. It's just like when a customer buys television now or a TV set. You can enjoy benefit from that TV set, but you will need to plug it to a source before you can use it. Okay, but that does not mean that the television doesn't have a distinct function. It has a distinct function, but of course you will need electricity for it to work. So that's distinct function. And also a distinct profit margin, meaning that you must be able to identify the profit you have made from that particular goods or services. And if you can do that, it means that the goods or services is actually separately identifiable. For you to have a distinct profit margin, it must be, that means the goods or services is separately identifiable. Separately identifiable in the sense that that goods or services, you don't integrate it with other goods or services. Meaning it is not like a raw material or an input to another goods or services. It's not an input, it is not integrated. Meaning it doesn't have to make other goods or services to function. No, he's on his own. It doesn't integrate with other goods or services. Another one is that it doesn't modify or customize another goods or services. And it is not highly dependent or highly interrelated with other goods or services. So that is what we mean by a good or services being distinct. So distinct is the core of step 2. When you identify the performance obligation or the promised goods or services, you account for each of them separately if they are distinct. And distinct means that goods or services can be sold separately because it has a distinct function and a distinct profit margin. A distinct function in the sense that the customer can benefit from it on his own. A distinct profit margin in the sense that it's separately identifiable. So you can know how much profit you are making on him. So it doesn't integrate with other goods or services. It doesn't modify other goods or services. And it's not highly dependent or highly interrelated with other goods or services. And that is all for step 2. Let's look at the question. A company called Wiki Limited. No, I need somebody to read because it's getting late. I've never done. Okay, it's just 18 after 10. Okay. I need somebody to read in this class. I need to be sure that people are with me. I should not be talking to myself. Anybody?
Ricky Limited, a contractor, enters a contract to build a hospital for customers. Ricky Limited is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Ricky Limited and its competitors regularly sells many of these goods and services separately to other customers. Explain whether the promised goods and services can be treated as a separate performance obligation.
So from here now, the separate goods or services here are engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Okay, because the contract is to build a hospital. So the question is, can we treat each of these one as a separate performance obligation? Okay. So do they have a distinct function? That's the first question. Can the customer, if you offer engineering alone, like we give him his building plan and all of that, can he benefit from that on his own? Of course, the answer is no. Or can he benefit from site clearance on his own? The answer is no. So each of them don't have a distinct function. So the customer cannot benefit from them separately or on their own. And also you cannot determine distinct profit margin from them because they are not separately identifiable, right? They are not separately identifiable in the sense that they are integrated into one another. They are highly interrelated with one another and they even modify one another. Because you cannot move to site clearance without engineering. You cannot do foundation without site clearance. Without foundation, you cannot move to procurement. You cannot move to like that. So they are highly interdependent and interrelated. So for that reason, we are going to treat all of these performance obligation as a single performance obligation, not separate performance obligation, because they don't meet the criteria as being distinct. Okay, please read the next question, please.
Halo Limited, a startup tech company, develops an app for use by businesses. It enters into a contract with a customer to supply the following: license to use the app, installation service. This may require an upgrade to the computer operating system, technical support for 4 years, 3 years of update. The installation service can be performed by Kalu Limited competitors and it does not modify the app. The app can remain functional without the updates and technical support. Explain whether the promised goods and services can be treated as a separate performance obligation.
Okay, so the performance obligation here is license to use the app, installation, technical support, and 3 years update. So can we treat each of these as a separate performance obligation? So the first thing is that do they have distinct function? Can a customer benefit from each of them separately? Let's see. The question said the installation service can be performed by Kako competitor and it does not modify the app. The app can remain functional without update and technical support. Okay. So that means without installation, technical support, update, as soon as the Kako give his customer license, the app is functional, right? And it doesn't have to be Kako that would install because you can get competitors to install. So definitely the customer can just go to Kako and get just license. So license has a distinct function. The customer can benefit from it on his own or together with other goods that are readily available to the customer. So when the customer gets the license, he can walk to another person for installation. The technical support and updates, the app doesn't even need it. The app is functional without them. But if the customer wants technical support, why not? If they want updates, why not? But they don't affect the function of, so each of them has a distinct function. And from the information given to us, they are all separately identifiable. They are not interrelated. They are not interdependent. They don't modify one another. And also, they don't integrate into one another. So we are going to treat each of these performance obligations as distinct, as a separate performance obligation. So it's a separate performance obligation because they are distinct. Okay, so that's step 2. So step 3. So step 3 is the transaction price. And ultimately, this transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services, excluding amounts collected on behalf of third parties, for example, VAT. So transaction price is just how much you have charged in the contract. So how much you are entitled to from the customer in exchange for transferring goods or services. So, and you see, when it comes to transaction price, it's quite straightforward. So there's nothing much here. You just need to understand the fact that the consideration might include some variable amounts in the sense that there might be discounts to the customer. So when there are discounts, that might affect how much you recognize as revenue. Another one is time value of money. Okay. If you have given if the payment period is such a long period of time, that means you might have to consider some element of interest that you would have to recognize as also income. So if the credit period you are giving to the customer is so long, then you have to consider time value of money. And also there are some transaction price that would be non-cash, so it's possible. And also, if you had promised the customer some amounts that will be payable to them, like you said that if they buy something from you, you give them bag of rice, you give them ram, you give them this and that. You need to consider that because you would remove all of that from your revenue, from the transaction price. So basically, that is transaction price. It's very flexible. It depends on the situation. So that, because what we want you to ultimately recognize as revenue is the consideration, is the money that would ultimately, that you are entitled to. So anything that would affect what you are entitled to, that you have to give somebody from it, you need to remove it from the transaction price. So if you look at this question now, this guy sells laptops. So he now told, in fact, he sells the laptop at 500 naira per unit. So he now made a contract with his customer that if they buy more than 500, that the price would reduce retrospectively to 450, which means that even those ones we sold to them before they met the 500 milestone, we would give them 15 naira back on those ones they have bought already. So all they just need to do is meet 500 milestone in a year. We will reduce the price retrospectively to 450. That is the one they have bought before at 500. We'll give you 15 naira back. So that was the deal he entered. So at the end of the first quarter, the customer only bought 70. So he then looked at it and said that no, there's no way this customer would meet 500. So that's that. In the second quarter, the customer bought additional 250. So that means the customer has already bought more than half. So you then estimate that no, this customer would exceed 500 and will get you'll be able to get that discount of 450 naira that will be sending to them at 450 naira. So you now say calculate the revenue in the first quarter and in the second quarter. In the first quarter, that one, the customer only bought 70. So there's no way. The question say that he believes they will not meet up with the 500 milestone. So he will recognize revenue at 500 naira. So that's 35,000. But in the second quarter, the customer bought 250. So at this point now, the question told us that he estimates that the customer will meet up with the 500. So we're going to recognize revenue at 450 naira. So that's 112. Don't forget that the reduction is retrospective. So even the 70 as bought earlier, we're going to return 15 naira on each of them. So equaling 35. So the revenue recognized in quarter two will be the 112,500 minus how much we are returning. So we're only going to recognize 109,000 as revenue. We are recognizing only 109,000 as revenue. So that's transaction price, and there could be other scenarios you could have. Now, step 4. Step 4 says allocate the transaction price to the performance obligation. You see, step 4 is only applicable where we have more than one performance obligation that are distinct in a contract. So that's the only scenario where we'll be talking about allocating transaction price to performance obligation. And usually, when we have contracts that we have different promised goods or services, most contracts will have known how much we are charging, how much the customer will pay for each of those goods or services. We will have known. So for those ones now, there's no stress. This step 4 is not necessary. So because we already know how much we are charging for each goods or services. Now, this step 4 is only relevant in a scenario whereby the customer just bundled the goods or services, those separate goods or services. He just charges a single price for everything. So as soon as we have identified that there are distinct goods or services, you see that single price is charging for everything. we would have to allocate that price to each of those performance obligations separately. So look at this scenario. So there is a network service company. So it gives customers free handsets when they sign a 2-year contract for the provision of network services. So the handset has a standalone selling price of 200 naira. And the contract is for 40 naira per month. So how should revenue be recognized? So even though, if you look at this question, even though the company gives the customer free handsets, this handset, even though the company is not charging, it's a performance obligation that's separate because it has a distinct function and a distinct profit margin. It's separately identifiable. So we should be treated as a performance obligation, even though the company is not charging, it's free. While the 2-year contracts that the customer will pay 40 naira for, that one is clear. So, and they told us the standalone selling price that if they were to charge for this handset, they will have sold it for 200. Unfortunately, they are not selling. So what we do is that, you see, this 40 naira per month, we have to allocate it between that network service and the handsets. We need to allocate it. And then how do we allocate it? He said we allocate it in proportion to the standalone selling prices of the goods or services. So how do we do that? So we'll get the handsets. The question already told us that its standalone selling price is 200. For the network, the standalone selling price is 40 naira times 24, which is 960. So a total standalone selling prices of 1,160. So we get a ratio 200 over 1,160 is 17%. 960 over 1,160 is 83%. So it is this percentage that we're going to use to share the transaction price, because the transaction price in this contract is just 40 naira per month, which is 960. So let's share it. So the total receipt in this contract is 960, which is the transaction price. That's the consideration. So we're going to allocate it to the separate performance obligation. So in year one now, because this is a 2-year contract, so in year one, the handset, out of the 960 we are expecting to collect, so 17% will go to handset. So we are going to recognize revenue for handsets of 162. So we are not going to say because we are giving the handset for free, so we'll not recognize any revenue. No, that's wrong. The handset is a separate performance obligation. So this 960 we are collecting as transaction price, a portion of it will be recognized for handset. While the remaining 83%, which is for the network service, we cannot recognize it entirely in year one because it's a 2-year contract. So half will be recognized in year one. The remaining half will be recognized in year two. So that's why we divided by 2 to get 399. So a total revenue of 561 will be recognized in year one. And in year two, 399. Okay. So this is another one. So what this one is teaching us is basically how to allocate transaction price to the performance obligation. And finally for today, step 5, which is to recognize revenue when or as the performance obligation is satisfied. So now we need to recognize revenue when you have satisfied the performance obligation. And what that means is that you have transferred goods or services to the customer. However, goods or services or performance obligation can be satisfied over time or at a point in time. So when we say over time, that means as the customer is receiving the goods is exactly the same time as you are also performing. So you perform, he enjoys the benefit. You perform, he enjoys the benefit. So it is simultaneous, right? You are working at the same time as he's enjoying the benefit, right? But it might also involve maybe the performance obligation is an asset that you have to create. So as you are creating, the customer is getting control. Like they are simultaneous, they are at the same time like that. So, and of course, as soon as when it's over time, whatever it is you have done to date, you'll be entitled to your money. Whatever it is you have done to date. Now, speaking about performance obligations satisfied over time, the core there is that the revenue you can recognize must be what you have done to date. The performance obligation you have satisfied to date. It's just like this lesson, this is our equity class, our econ class. Equity cannot recognize revenue for the entire money you have paid as of today because we have not satisfied the performance obligation totally, because this performance obligation is satisfied over time. So what we can recognize as revenue up to today is what we have done till today. And how would you even rate or calculate what we have done till today? So that's why this standard is saying that the amount of revenue recognized, okay, the amount of the entity must be able to measure the outcome of the performance obligation before you can recognize revenue. So that means we should be able to measure the outcome of what we want to do. If we can measure the outcome in such a way that we can say, okay, up to date, we have done 20%. By next month, we will have done 30%. By other month, we will have done 70%. Then that means we can measure the outcome like that. Then it will be easy to recognize revenue based on work completed. However, there are some services that it will not be possible to measure that kind of outcome in that manner. But if you are sure that you recover your costs, then the revenue you recognized will only be to the extent of the cost you have incurred. So you can only recognize revenue to the extent of the cost you are incurred. So talking about costs incurred, then that takes us to contract costs. So contract cost is the cost of obtaining a contract, like commission. So when you incurred some costs in obtaining a contract, and you are sure that you recover those costs, then you can recognize that kind of cost as an asset. But if you incur costs in obtaining a contract, and is a cost you will have incurred, whether the contract is obtained or whether the contract is not obtained, you still have to incur it, whether you have to pick up a form or something like that. So it's an unavoidable cost as far as the contract is concerned. Whether you get the contract or not, you still incur it. So that one, just expense them. But the one that you are sure that it's incurred majorly and is targeted in obtaining the contract, like sales commission, and you are sure you recover it, you capitalize those ones. But the one that, regardless of whether the contract is obtained or not, you incur, you expense those ones. So that's one aspect of contract cost of obtaining. It could be cost of fulfilling, because when you are finally obtained a contract, you have to do the work. So the costs, you need to accumulate it and recognize it as receivable, provided you have not collected your money. So that means they are recognized as an asset. Cost of fulfilling a contract. Of course, it has to be a cost that you can recover. Then, as they are now paying you your money, then those costs, you can then be expensing them gradually to P&L. You can be amortizing it based on the manner in which your customer is paying you. You can be recognizing it. So contract cost is the cost of obtaining a contract. You can either capitalize or expense that. And cost of fulfilling a contract are usually capitalized. Then you amortize them on a systematic basis, consistent with the way in which the customer is consistent with the way you are transferring the goods or services to the customer, or how you're expecting to collect your money back from the customer. That's all of this. I'm talking about where performance obligation is satisfied over time, right? So what took me to contract costs is a situation whereby you cannot measure the outcome. You cannot say, okay, up to date, we have done 20%. Because when performance obligation is satisfied over time, the revenue you can only recognize is what you have done till date. It's really that proportion of your contract price that you can recognize as revenue. But if you cannot measure what you have done to date, then you need to recognize revenue up to the point of the cost incurred to date. Okay, that was how I was explaining what contract cost means. However, when the performance obligation is satisfied at a point in time, and the point in time is the point where the customer obtains control of the promised assets, then we said, okay, you have satisfied the obligation at a point in time because the entity now has control. And it has control when the entity now has the right to payments, where the customer has legal title, the entity has transferred physical possession, and the risk and reward of ownership have been transferred to the customer. Another point you can recognize your revenue. Everything was revenue. Finally, for today, you need to understand the difference between a contract asset and a receivable. Mostly what we all know is receivable, trade receivable. But trade receivables is the money you're expecting from a customer or the right to consideration that is unconditional except for passage of time. That is, your money will be paid at a due date that is unconditional. It's only passage of time that is remaining or that is required before your payment is due. That's trade receivables. However, where your right to consideration is conditioned on something other than passage of time, then that one is a contract asset. Maybe you are expected to do something that you have not done. Not that you have not transferred the goods, you have, but there is still certain condition you need to meet. Like probably maybe you're supposed to fill a form, or probably you're supposed to send an invoice, or probably you're supposed to have sent an email. I mean, there's something you are supposed to do that you have not done. So where your right to consideration is conditioned on something other than passage of time. So it's not about at a particular date you collect your money. It's about there are things you need to do in addition to these goods you have transferred. So if there are conditions like that, then the money that is collectible, you don't debit it to trade receivables. you debit it to a contract asset. You debit it to a contract asset. Until those conditions are met, then you can debit trade receivables. Then when you eventually collect your money, then you cancel out the trade receivables. Okay,